You should begin.
Dr. Garry Keel is the owner and founder of Money Management Associates, LLC, a tax preparation and planning services company based in Ewing, New Jersey. Since its inception over 35 years ago, MMA has expanded to serve nearly 600 clients throughout New Jersey, Pennsylvania, and New York. MMA's mission is to deliver trusted and accurate tax preparation services along with 100% customer satisfaction. Garry received a BA from Rider College, now Rider University, an MED from Trenton State College, now the College of New Jersey, and his EDD from Fordham University. He's an active member of the National Society of Tax Preparers, as well as the National Association of Tax Professionals. He is a former tax instructor and trainer for H&R Block and Jackson Hewitt. Specializing in individual and small business tax preparation and planning, each year, Garry completes over 35 IRS-approved tax training credits to stay up to date with the latest tax rules and regulations. Garry also has a broad commitment to community service, including the Sustainable Ewing Township Green Team, where he serves as chairperson of the annual Fall Spin Bike Tour, former educational coach for Ewing High School Blue Devils football, a Rider University alumni volunteer, and fundraising captain, and is an active member of both Delta Upsilon chapter and Nu chapter of the Omega Psi Phi Fraternity Incorporated, serving as editor to the Oracle and director of public relations. A resident of Ewing, New Jersey, Garry is married to Lenora Keel and has a son and daughter-in-law, Gregory Keel and Jessica Keel. Above all, he is the devoted Mo-Pop to his two grandchildren, Jameson and Emery. Please join me in welcoming Dr. Garry M. Keel for this presentation.
Thank you, Janelle. Really appreciate that opening. Tonight, and I appreciate the Deltas inviting me to participate in today's program. The purpose of tonight is to basically give you information that I have gathered over 35 years that I think will help you in terms of your tax return this year, 2022, and perhaps helping you to plan for 2023. A couple of ground rules I'd like to just establish. Number one is that if you have any questions as I go, you can certainly put those in the chat, and someone will relay those questions to me, or I'll pick them up and try to answer them. However, whatever you put in the chat, please, please, please do not put any identifying information, no social security numbers, no particular names. If you want no information about a particular person, I want to try to keep that, of course, as private as possible. The tax rules is about 5,000 or more pages. So it's impossible for me to cover everything in an hour's time. So what I have tried to do is think of things that I have encountered from my current clients, as well as new clients when they come in the door that they ask me about. And so that's what I'm going to try to do tonight. I'm going to have, I think, 4 sections. Each section will be 6, 7, 8 minutes long. And I'll ask at that point, take a break and ask anyone if they have any questions specifically about that section. The first thing I would say before I actually start is don't be afraid of taxes. I mean, a lot of people, because they're afraid of numbers, or they think they're going to get audited, or they think that they can't read the document, are afraid of taxes. What I try to do with my clients, and those of you, I think some of my clients may be on tonight, they can probably attest that I try to make it as comfortable as possible and as simple as possible. So in that regard, if you want to grab a cup of coffee while we're talking, please do that. If you want to grab something to eat or munch on while we're talking, please do that, because we want to try to make it as comfortable as we possibly can as we go through this evening. And again, at any time when we talk about taxes. Just a little quick backdrop again. I got involved about 35 years ago because I had just gotten married. And up until that point, I had always gotten a refund. And from my understanding was that, and this was again 35, 36 years ago, was that the government just gave me some money. I didn't conceptually understand why I was getting a refund. But all I know is that once I got married, I no longer got a refund. And that didn't make me too happy. Because I figured like, well, the government must know inside my business. Now that I'm married, I can't get no money. And I started studying the tax rules. And then as was mentioned earlier, I started teaching the courses and finding out more and more about it. So that's kind of why I got started, was because I didn't know what I was doing. I didn't have any idea why I was getting money or not getting money. And I felt like once I got married and to the love of my life, I felt like I should be getting more money. And I wasn't getting any money. So that really bothered me. So that's kind of how I got involved. So with that, let's get started. I'm going to share my screen. Okay. Okay, so tonight I'm basically going to cover these particular topics. Now, again, the tax rules are so broad. I'm hoping that everyone tonight will be able to get something out of the presentation. But again, it's so broad and I can't cover everything. But I try to do it in a way that I thought people typically might have some questions or have some concerns about their taxes. So I'm going to start out by doing some tax basics. I'm going to then talk about some selected tax items for 22. I'm going to talk about some New Jersey and PA state tax items for 22, some selected tax items for 23, which would be sort of the planning, some final comments, and then some selected resources. Okay, so we're ready to get going. Okay. Bear with me. Okay, so tax basics. This year, the filing deadline for 22 will be Tuesday, April 18th. Now, why? Because the 15th falls on a Saturday. And when the 15th falls on a Saturday, they go to the next available day. Now, you might say, why not Monday? Well, Monday is, I think, called Box Day out of Boston, and they can't do taxes on that particular day. So the next filing day will be Tuesday, April 18th. Now, for tax preparers like myself, that's great because I get 3 extra days to work with clients. The only downside is people come in panicking during those last couple of days, but at least having 3 extra days to work with clients is a really good thing. There is a 6-month automatic extension. However, with extensions, and this is a question I get with clients, extensions do not mean you have more time to pay. Extensions just simply mean that you have more time to file. If you end up owing after you do your extension, they charge a penalty and interest back to April 15th. So you just won't get a penalty for a non-filing penalty, but you still will get a penalty for filing late. I'm sorry, not filing late. You get a penalty for if you're depending on how much you owe, and also interest back to April 18th. So my clients who want to do extensions, because anything might be a family concern, something might be happening or whatever, I tell them that even though they have until October to still try to get in as soon as possible to get their extension done between April 18th and typically October 15th. So just keep that in mind. If you do decide to do an extension for whatever reason, that don't think you have more time to pay, you still have to pay if you owe. In fact, if you owe, you do sort of an estimate, you still need to send in a check on April 18th to cover yourself. Another thing that I think is important is just some common income subject to federal tax information. Some of these things, most of these things are things that you already know. Obviously, employee compensation, unemployment, pensions, annuities, IRA distribution, ordinary dividends, stocks and bonds. You might not know that refunds, perhaps if you are itemizing, that refund also might be a tax item on your next tax return. Also, another thing that people fail to realize, depending on their income, you may have to pay taxes on your Social Security. There's a formula in place for that to happen. It's not a guarantee, but people who get Social Security and also have a job or have some other sources of income need to be very conscientious of the fact that their Social Security benefits might perhaps get taxed. Other things are things like raffles, awards, and prizes. Another thing which is interesting, that if you sell your vehicle or you sell anything, you have a garage sale, and you sell anything for a profit, that profit is technically taxable. Now, How many of you and us file that in as income? But as a tax man, I would never not tell you what to file correctly. So if you earn some money from a garage sale, and of course you got to take your item, what you sold it for, maybe it was worth only $10 and you sold it for $8, then there's obviously no gain. But if it's a $10 item and you sell it for $20, that $10 technically has to go on your tax return as income. And there's a section that's called other income that you would post that. Some other things that people might not realize is that there are some items that are not taxed. And this is a question that I often get as well. People, your life insurance proceeds. If you have from someone's passing and you have life insurance, none of that is taxable to the federal government. It may be taxed to the state, not normally, but it's not taxed to the federal government. So if you have a big, huge life insurance settlement, it's free money. Workers' compensation. If you get hurt on the job and you get workers' compensation, again, no tax, no federal tax on that. Child support, some of you may know that already, is not taxed. Interest on state or local government bonds is not taxed. And then another thing I think that particularly now because of the housing market, that people are realizing that you can sell your home, your main home, and if you have a profit of $250,000 as a single person or head of household, there's no taxes on that. So people have called me and said, Gary, I just sold my house for $400,000. What are the tax implications? The first thing I asked them is, what did you buy it for? I bought it for $300,000. That $100,000 that they gained on that house is not taxed. That's a beautiful thing. It used to be at a time where you had to take that money and roll it into a new house, but that's not the case anymore. If you're a marriage filing joint, the waiver is $500,000, which again, you might buy a house for $300,000-$400,000, you sell it for $800,000, you walk away with $400,000, no taxes on it, money in your pocket. You don't have to buy a new house, and you keep it moving. In fact, it doesn't even show up on your tax return. The only time your house would show up on your tax return is if you sold it for more than that amount. Then you would have to pay taxes on that difference. So again, as an example, you bought it for $100,000, you sold it for $700,000. The first $500,000 is not taxed. The next $100,000, you would have to include that on your tax return. Let me just mention something about crypto. Crypto is something that a lot of people are involved in now. And in fact, I really try not to play around with crypto because it's still not totally organized in a fashion for tax preparers to operate. So you have to be very specialized, and I really am not there yet. And so I don't really fool around with crypto. However, people that have crypto, the main thing that you want to keep in mind is that it's treated as capital gain or capital loss. And you have to report all those transactions. I've had a person, maybe some of you have done like Robinhood, and I've had a person come into my office with 200-300 transactions, and each one of those transactions has to get coded. So, and the transaction might be for 20 cents or it might be for $2, but you still have to code it in. So for those who are doing with crypto, make sure you have your records in order. The IRS is cracking down. In fact, I'll show you on the next slide. There's a question on the new 1040 that specifically asks about digital currency. Dependents, children, typically less than 19 or years old or 24. In fact, less than 19, they can earn pretty much anything. Less or 24 if they're in post-high school is fine. If they're over those ages, you can still claim your child, or you can claim someone else, but they cannot have earned more than $5,000 during that year that you claim them. They don't even have to be your relative. They could be someone who's lived with you for the entire year, more than 6 months, and you pay more than 50% of their support. So I had a client last year who had a friend that basically the friend doesn't work. The friend stays at their house. The friend is 35, 40 years old. They were able to claim that person as a dependent. So just because they're not your children does not mean that you cannot have them as a dependent. Another one typically is parents. You can claim your parent. You just have to provide more than 50% of their support. They do not have to live with you. If you have a parent in a nursing home or you have a parent living somewhere else, they have their own home. The issue is, as long as you pay more than 50% of their support. How do you figure that out? First thing first is, what earnings do they have? Typically, parents have Social Security or pension. So that money is the first money that takes care of them. You would have to be able to say, with that Social Security, with that pension, you still pay more than 50% to take care of them. You can do that. There's no problem doing that. In fact, if you have multiple siblings, like I do, a sibling can actually take a parent 1 year, the other sibling can take the other year, as long as they meet that qualification of being able to provide more than 50% of the support, and that's pretty much it. Filing requirements. I'm going to show you a chart. Okay, so in order to file, these are the things that require you to file. If you're single, under 65, you have to file if you earn at least $12,950. Marriage filing joint, both under 65, $25,900, and you can see there what the numbers are. The main thing with filing requirements is that filing requirements are not necessarily related to age. I mean, you can get a little bit of extra benefit by age, but it's by earnings. So I have people come to the office and say, well, my parent doesn't work, or they don't get, I don't have any resources. The question, well, I'm 60 years old or 80 years old. The question is, how much money did you make? Or how much money did you show as being filing? And then that's what we can determine whether you have to file or not. Okay, next thing is the tax rates schedule. Now, tax rates, the important thing there, I do apologize if it's a little cloudy. I tried to make it in a way that you could see it, but I hope that you can. But tax rates are basically telling you how much of your income is going to get taxed at what percent. So you might make $180,000 a year in a single person. But if you are, after your deductions and things, you only show taxable of 100,000, then in our example there, you would be taxed at 22% versus 24%, which is a good thing. But this at least gives you some idea of how much, when you earn money, how much of it is going to be taxed by the federal government. Then, of course, you got to add in the state for New Jersey and other states as well. So you could very well find yourself, if you're in the 37% tax bracket, maybe paying 40, 45, 50% of your earnings in taxes. But it's good for you to know that. Next thing I want to show you guys is standard deduction versus itemized deductions. Now, almost everyone now uses the standard deduction because of your President Trump back in 2019 changed the tax rules. Many of us in New Jersey were able to itemize prior to 19 because of what they call the SALT items, which is your income, I mean your taxes and your property taxes and your income taxes. But because there's now a cap on that of $10,000, many of us are even already above that $10,000 threshold. And then if you don't have a large mortgage and you don't give many charitable donations, chances are you do not have an itemized deduction tax return. Right now, the latest figure is that about 24% of the people in the country are able to itemize. More often than not, you are taking the standard deduction. The standard deduction, I try to explain to people, it takes into consideration all those items, your taxes, your charity donations, your medical expenses, all that the government figures out based on a particular income. These are going to be deductions that we're going to give you. No receipts, no question. You just get this as a particular deduction. For 2022, for a married persons is $25,900. Single people, $12,950. Head of household, $19,400. And married filing separately, $12,950. Two more items and I'll take a break and answer any questions. Okay, the last two items in this section is credits and deductions. A credit is when you're able to take an amount of money directly off of your taxes. Credits are always the better way to go. And there are a lot of credits, and some of which I'm going to cover later on. So you want to try to work with whoever you're working with. You want to ask what kind of credits that you might be available to you. Because if you can have credits, it reduces your taxes. The other option is deductions. Deductions reduces your income. If you have less income, conceptually, you have less taxes to pay. But your idea is you always want to try to deal with credits. It's nice to have some deductions. That's where your standard comes in, your standard deduction. But if at all possible, credits is where you want to go and talk with people about credits. But deductions are reducing your income. Last thing is refund and liability. I'm a tax guy, and I'm not really for big refunds, particularly when I have a client who gets a big refund and throughout the year they're struggling. They're paying with credit cards, they're having a tough time making their mortgage payments, because basically, and this goes back to my original reason for getting involved with taxes, is you're getting a refund because the government is holding your money. Now, people say to me, Gary, that's a forced savings. Yeah, I guess maybe that's the best argument I've heard for savings, but you're giving the government your money. The government is using it interest-free, and they decide to give it back to you 14 months later. It's not a good financial move, at least from a finance guy. It's just not, particularly if you have bills to pay. I'm always more in tune to encourage my clients to have a small liability, maybe $100, maybe get it back $100. That means that they have used all of their money all year long, and they're able to do whatever they need to do. They don't owe the government anything. The government doesn't owe them anything. They've been able to use their money to cover all expenses or whatever expenses they may have had for that year. But again, that's a choice that a client makes. When I sit with my client, we talk about that. First thing, one of the first things we talk about, particularly when the return is done, is, are you happy with the refund? And if you're not, we can talk about how to improve that. Are you happy with the liability? If you're not, we can change that, because it's all built by numbers, and it's all built by your tax return, being able to handle how much it is being withheld. Okay, so I'm going to stop there for a couple of minutes. Are there any questions in the box that I can answer?
Yes, we have a few.
Okay.
The first question, do we have credits on non-itemized filings?
Yes. Yes, credits have nothing to do with itemizing. It has nothing to do. It has to do with earnings. It has to do you qualify? And if you do, then you get that credit. And again, I'm going to talk about credits in a couple of minutes.
Okay.
But you do not have to itemize to get a credit.
Okay. The next question, how much of pensions and Social Security benefits are taxable?
The pension is a little bit different, but Social Security, the maximum taxable Social Security, the maximum is 85% of whatever you get. Now, once you get to that, once you say you have $1,000 of Social Security, the maximum Social Security that you can be taxed on is $850. And that's based on all your other income. Now, once you get to that 850, then you get into your tax rate. Are you paying 22% on that 850? Are you paying 24%? Are you paying 10%? But the maximum amount of Social Security is 85%. Most people who have Social Security being taxed, they are taxed by 50%. So in other words, that $1,000 example, 500 of that 1,000 would be taxed. And then you start dealing with the percentages of tax rate. Most people who have Social Security, if you're getting 85% of your Social Security being taxed, then you're making some really good money. And believe me, you are. As far as pension is concerned, your pension is taxed once you reach those particular limits. There are some discounts or some advantages in New Jersey, which I'll talk about, and also in PA. But typically, whatever you earn in pension, you got to pay taxes on it, particularly in New Jersey.
Okay. The next question, if you sell your home and make a profit, would you have to pay New Jersey state taxes?
If you read, if you're in that category of that waiver, no.
What is the difference with single household versus head of household?
Well, this is a good question, because head of household means that you have to have a child, you have to be unmarried, and that's pretty much it. So you could be single and you can be head of household, but if you don't have a child, you can't be head of household. So for instance, what happens sometimes, a client will come to me, I take care of the house, I have a child, I have an adult son who lives with me, or adult daughter, they're on their own, they're working or whatever, but I pay the bills. In that case, you're single, you're not head of household. You have to have a dependent in order to be head of household, whether you're in order to be single versus just being single. Does that make sense? Is that clear? You got to have a dependent to be head of household for tax purposes.
How beneficial are flexible spending accounts in reducing your taxable income? And that's the last question.
Okay, that's a good question too. If you can have that, if you can have flexible spending, that's excellent, because it reduces your income. And again, it goes back to, if you reduce your income, then you have less taxes. So yes, that's a good move if you have a company that allows that.
I'm sorry, we have two more questions.
Okay.
If I am married, but my spouse and I do not live together, can I still file married jointly?
Yes, you can still do marriage. You can do marriage jointly or marriage separately. You would probably want to see which one is best in terms of taxes.
What was the note about Bitcoin waiver?
There was no waiver discussion about it. It was just the fact that if you have Bitcoin, make sure that you have copious records that include what you bought it for, whatever the digital item is, and what you sold it for, because that's going to be important for you to claim whether there's income or not on that particular item.
Okay, that was the last question.
Okay, very good. Okay, next we're going to go to, okay, some individual items. This is where you get the credits that I was talking about. Child and dependent care credit, up to $3,000 of qualifying expenses. You can take a credit for one child, or up to $6,000 a credit for two or more children. Now, last year it was $5,000 and $10,000, but it has been rolled back to 2021 rules. So you have $3,000 of qualifying expenses. That means your daycare, that means your summer camp, that means after school care. Then you can get a credit, not for $3,000, but you use the $3,000 to calculate your credit. Your credit goes from 30% down to 20%, depending on how much you have paid in. Okay, child tax credit is now $2,000 for 2022. It was $3,000 for 2021, and the child must be under 17. Now, in the last year, the child could be over 17, but now rolling back to 21, your child now has to be under 17. They can't be 17. They have to be 16 and some change or less. The education credit, this is a good credit. It's on a credit up to, you can spend up to $4,000 for tuition, books, computers, supplies, etc. And you can get a credit of $2,500 per person per year, up to 4 years. A lot of people do take that because a lot of people obviously send their kids to school, or they even go to school themselves. The other thing that is interesting is that it's something called a lifetime learning credit. Lifetime learning credit is for if you're taking classes that are not necessarily going towards a degree. You can still take a credit for up to $2,000, but the $2,000 is all on one return. So if you have 5 people that are pursuing some other kinds of education, and they each want to take the lifetime learning credit, the maximum for that tax return is $2,000, but the maximum for the American Opportunity Credit is $2,500 per person. So you can see the difference there. It is a credit, but if you're in school, your kids are in school going towards a degree, you're going to get a bigger tax credit. And again, it's a credit, so it reduces your taxes, not just reduces your income. Earned income tax credit. Many of you perhaps have heard about that. you can get a credit that ranges from $560 with no children up to $6,935 with 3 or more children. There are income requirements, which I didn't list here, but they are. And if you want to know those, then obviously I can pull those out for you. But it's a big deduction for people who are in relatively low income status. The person that you have to have a dependent, they have to have a social security number, and the person who's claiming the credit has to be between 25 and 65. Now, which I'll come back to as well in a second. Student loan interest. There's a maximum of $2,500 based again on income. A lot of credits, as you can see, are based on a person's income. If you're over the income, if you're over the income by $1, you lose the credit. I mean, they have to stop somewhere. Residential energy credit, a lot of people miss this. If you repair windows, doors, heaters, etc., you can take up to $500 as a credit, on your home. You just have to, it's a one-time, not one time, it's a lifetime $500 for that one home. So if you do it this year, or if you do 250 last year, you can still do another 250 this year. And I'm going to talk about what's going to happen in 2023 with the energy credit. Residential indebtedness. Unfortunately, people are losing their homes. You can waive that money to have no taxes on it up to $750,000. Normally, cancellation of credit, there is taxes on that as income. But in the case of your home, the government will allow $750,000 off of not having to pay any taxes on your main residence. Educator expense this year is now $300. The interesting part about that is that it now includes PPP items, shields, sanitizers, gloves, and things of that nature. Now, for those of you who are K-12 educators, whether you're in the school, whether you're in the classroom or you're in the building, $300 is not a lot of money, but it's something. And it is something that you can do as a deduction. Unfortunately, it's not a credit, it is a deduction. So it reduces your income. Rental losses up to 25K. If you have rental property and your income is between 100,000 and 150,000, it's a sliding scale. You can take up to $25,000 losses, which goes against your other income, which is nice. Most people who get rental properties are not able to take this item because their income typically is over 150,000. So they take the losses and they can carry the losses forward, which is a good thing, but they can't take them on this particular year. I have people who have rental property, and one of the things that we discuss is that rental property really is not for taxes. Rental property is really for appreciation and being able to use those assets for other things. If you think you're going to do rental property for tax purposes, it's pretty tough to do. But having rental property and collecting rent is not a bad thing in terms of your investments and in your, your future. I already talked about you sell your house, 250K and 500K. You have to have lived in that house 2 out of 5 years. You can take a 26% credit for purchase or lease of solar on your main home. So again, it's a credit. 26% say, solar might cost you $50,000. So 26% of that is, what's that, 13, no, it's like, well, whatever. You guys, 50,000 times 0.26. So it's 13,000, yes, that's what I thought. It's 13,000 you can have as a credit. Now, if you take that credit, or if you take any, I should say any, if you take that credit in particular, and it reduces your tax to 0. So say you owe 8,000, you take a $50,000 solar, you get $13,000 credit. That 8,000 get washed, so you get all of that back, and then the 5,000 that's left over gets carried forward. So you can use it for the next year to help offset next year's taxes. Electric vehicles, a number of people are buying electric vehicles. Depending on the vehicle, you can take up to $7,500. The vehicle has to cost less than $55K. If it's an SUV, it has to be less than 80K, and your income cannot exceed 150,000 single or 225,000 head of household and 300,000 married filing jointly. Student loans. This is a whole big crazy situation with student loans. In the past, student loans, if you cancel those loans, they were considered income and you had to pay taxes on it. But now you have a situation where the government is involved, but still Congress and the Supreme Court still have not made a final decision. But at least for 22, if you have student loan cancellation, you do not have to pay any taxes on it. Military, just a couple of items quickly. Combat pay is tax-free, and they do get an extra extension if they're in a combat zone. I'll stop there. Questions?
Yes.
Mm-hmm.
Is there an income limit on receiving the education credit?
Yes, there is. Good question. There's an income limit for single people up to 80,000, married filing jointly up to 160,000. And it's a sliding scale, but there is an income requirement, absolutely.
Do you know whether the loan forgiveness is going to be taxed?
It will not be taxed for 22. What's going to happen in 23? I don't know, because Congress and the Supreme Court is still involved. But at least for 22, it will not be taxed.
Okay. Can you gain more or additional tax credits for education if you have a business where professional training is required as a part of the business?
No, because again, the education credit is either, if the opportunity credit, you have to be pursuing a degree, whether it's business related or not, or if it's not pursuing a degree, it's a lifetime learning credit. Now, prior to say 17, you could take an education credit, or actually education expenses on your business if you were doing education related to your business, but not anymore.
Okay.
Now, if you go, but let me say this, if you go to a seminar or if you go to some training, you can take that off as a business expense if that was the question the person was asking.
I'm not sure if they want to come off mute and see if you answered their question really quick, or if they're okay with that.
Yeah. Thank
Okay.
you. The question please answered.
Okay, thank you. And the last question, will the student loan forgiveness produce a 1099?
I would say if it does, it's going to be a 1099-C for cancellation of debt. Now, the holding company would generate that because they know, well, no, they don't know, because not every loan is going to be waived. It's just the federal loans. So there will probably be some 1099-Cs, yes, probably. By somebody, particularly like the private banks, they're probably going to send a 1099-C. And in that case, so I should back up. In that case, those loans are probably going to have to be taxed. Those forgiveness, because it's cancellation of debt of private loans.
Okay. Is there an age limit on the American Opportunity Credit?
No. No, the issue is the 4 years and what kind of school you're going to.
And that was the last question.
Okay, great. Okie dokie, let's go to the next item. Okay, so this is the new 1040. And I know it's kind of tough for you to see because again, just excuse me on that. But this asterisk up here is the new question that's going to be asked about digital assets. This is where if you do have Bitcoin or something along those lines, you'll have to answer yes. And if you answer yes, it's going to require you to have additional information to give to your preparer or you do yourself. Down here at the bottom is where your standard deduction would go. At the top, I just indicate this is where your credit for the child tax credit would go, and the earned income credit and the education credit. So basically just showing you where on your tax return those items are going to show up. Okay, This is one of my favorites, small business in the gig economy. A lot of people are in the gig economy. DoorDashes, Airbnb, Uber, all of that. Those dollars have to be taxed. If you have earnings over $400, they get taxed. Now, the company are supposed to send you, or if you do it through credit card, you're supposed to get what's called a 1099-K. But even if they don't, if you know you have received X dollars, then you need to report that as income. Now, once you have $400 or more, you have to pay self-employment tax. Self-employment tax is Medicare and Social Security. If you are working, your employer pays your half of Medicare and Social Security. But because you're self-employed, you have to pay the whole 100%. So that is a tax that a lot of small businesses don't realize. They think of only just income taxes, which again, Social Security and Medicare are sort of income taxes. But it's more than just your tax rate schedule when you're a small business owner. You have to also pay Medicare and Social Security if you over $400. The annual mileage rate this year from January to June was 58.5 cents. So if you have a business and you're on the road, you can deduct 58.5 cents per mile. From July to December is 62.5 cents. Obviously, that's because all the different problems with the gas rates. Now, clients come to me sometime with gas receipts. Now, gas receipts, unless you're using that vehicle for 100% of the time, it is meaningless because your mileage is almost always going to exceed your gas receipt. If you just think of about 10 miles or 100 miles at 58.5 cents, that's $58. You might fill up your tank for $58 and you drive all over the place, but your 100 miles is $58 by itself. So mileage is almost always better than your gas receipts. This year, there's 100% meal deduction. If you're conducting business, not that you're just hanging out at McDonald's or you go home for lunch, you have to be conducting business, either cutting a deal, working on a contract, going to look at a site. I mean, it has to be business related. Quarterly payments. If you earn money, even through the gig economy or independent contractor, you have to, or you should, you don't have to, but you should pay quarterly estimated payments, taxes to the government. The government wants their money as you go. Your job for you gives them your money as you go. When you get paid, they send the taxes in for you. While you're working on your own, nobody's sending in those taxes for you, so you have to do it on your own. So you do that quarterly. There's 4 quarters, April 15th, June 15th, September 15th, and then they allow the last one to be January of the following year. Very, very simple to do quarterly tax returns, to be quite honest though, folks. You basically take your income for that period of time, you minus any expenses you had, whatever that dollar amount is, that's what you pay taxes on. And typically, I say to my clients, about 20% to be on the safe side. Business usage of home. Okay, so there's a simplified method, which basically says you take the square foot of the business portion of your home and you multiply that by $5 per square foot up to a maximum of $1,500. It's a good deduction, particularly for people who don't have a room set aside. They just have some space, might be a freelance writer or someone who has all kinds of stuff all through their home. If they do a square footage, they think a certain amount of square feet they use in their home for business, they can still take a home deduction. The regular method is you take your business, you take a room or several rooms and you use that against your total house. So if you have 1 room that's for business and you have 8 rooms, then you take 12.5% of everything and those items that I have there posted. Repairs, mortgage interest, taxes, insurance, appreciation. That typically is much better than the than the simplified method. Simplified method really is just, they made it up a few years ago to make it easy for people to have to not do those calculations. Record keeping can help you track your income, deduction, expenses, and complete your return. Expenses. To be deductible, a business expense must be both ordinary and necessary. An ordinary expense is one that is common and accepted in the industry. Now, clients come to me, and I'm not a bookkeeper, and this is interesting because people think that the guy who does taxes can do it all. I don't. I know very clearly what I do and what I don't do. I don't do record, I understand record keeping, and I can help you, but I don't do your record keeping. That's a whole nother person, a bookkeeper or someone of that nature. I also don't do hard accounting being like audits and compilations and reconciliations. I can understand that, I can do that, but that's not my area. That's for someone who is specialized in that. I'm the tax guy, and I kind of try to stay in my lane. But expenses have to be ordinary and necessary. So clients, so I'm saying, going back, clients come to me and say, is this expense deductible? I don't know your industry. If it is necessary and ordinary, it is. If it's not, then it's not. One of the things that are common that I hear is, I just bought a suit. Well, if you bought a suit, you can wear that suit anywhere. So that's not, now if you put your company name on the suit, then that becomes a uniform. So clothing is not a necessary and ordinary expense that you claim as an expense on business, because you got to wear clothes. And the fact that you want to be sporty, then go ahead and be sporty. That might be what's necessary to do work within your company. Your income, again, whether it's gig work or regular sales, you want to keep that. Even if you don't get a Form 1099, if you do credit card transactions, you're most likely going to get a 1099-K. Well, I'm really moving, I got to move faster. Hiring your child, that's a good one. If they're under 18, they can earn up to $12,950 and pay no taxes. And guess what? Kanita would love this, because you can take that $12,950 and go talk to her about setting up an IRA or setting up some other kind of investment. So think about, if you have kids, that you can do that. Difference between a hobby and business. A business, you have to be trying to make a profit 2 out of 5 years. And in that way, you can deduct the expenses. Reporting expenses for your non-partnership LLC is going Schedule C. Many people think that they have to, that their business return is different than their personal. Not when you're a non-partnership LLC. It actually all goes together. Paying yourself as a sole proprietor, you take a draw. You don't pay yourself a W-2. Then Schedule C, which is what I have next. I'll try to move along. I didn't realize it was so late. Okay, that's your 1040. I'm sorry, that was previous. Next. Okay, here's your Schedule C. I marked down at the bottom where your office and home expense will go. But basically, you can see the different categories you put in, and you have at the top number 1 where your income is. Okay, any quick questions?
Yes. If you started a business in 2022 and haven't had any income, do you have to file?
You should, because you probably have had some expenses, some startup expenses, and you may have also registered the business. And if you register in New Jersey, it costs a couple $100. Those are deductions. So yes, you should.
Okay.
And in fact, let me say, and if you don't take the expenses in 22, you can't take them in 23.
Okay. Are you penalized if you do not pay the income taxes quarterly if you are an independent contractor?
If you don't pay enough, yes, you are penalized. You have to pay at least 100% of what you paid the year before, or 90% of what you owe this year. So you have to look at what were your taxes the year before, and you have to at least collectively over the course of the year, through your job or through the business, have to pay at least 100% of that for the new year, or 90% of what you think you're going to owe this year. A little complicated, but to answer the question, yes, you would get penalized.
Okay, and I guess this is just kind of a personal thing. Can you help us even if we live in another state?
Yeah, the only issue with out of state is the state income tax piece. But federal, if you're in the 50 states, your taxes are the same.
Okay, and the last question, is there ever a time where an employer does not have to pay federal taxes on an employee?
Not legally. Not legally. If they're an employer and you're an employee, they got to pay. You got to have the taxes. Now you could be tax exempt. you can put that in if you don't think you're going to pay any taxes that year. A lot of kids can do that, which would be a good idea. If a kid is only going to earn a couple of $1,000s and you saw that they could earn up to 12,000, they can put in tax exempt. And in that case, the employer wouldn't hold any taxes.
And that was the last question.
Okay, real
Oh,
quick.
wait, we have one more. I'm sorry.
Uh-huh.
As a small business owner and you hire your child, what form would you supply them with?
You wouldn't have to supply them with anything. You can pay them straight cash. You just need to keep some records like an application. I mean, make it kind of formal. Application, a timesheet, a job description. But that's all. You just have to keep that. You can pay them a check like out of your business account. If you want to issue them a document like a 1099, you can do that. But it's more the documentation that you need to keep.
And that was the last question.
Okay. Quickly for New Jersey, some things that are not subject to New Jersey: Social Security, cancellation of debt, unemployment. There's a pension exclusion in New Jersey. State retirees, if you're over 62, you can get all your money back that you put in the pension, or up to 3 years, however long it takes. Other pension, there is an exclusion for that one as well. One thing, this is interesting: college student dependent under 24, you get an extra exemption. A lot of people forget that. If you have a child under 24 who is a student, you get an extra $1,000 deduction off of New Jersey. 2% of medical expenses. A lot of people miss this one as well because they don't think that they can do medical on federal, which they probably can't, but they might be able to do it on New Jersey. Taxes paid to another jurisdiction. If you pay income taxes to somebody else, you can get that credit against your New Jersey taxes. Property tax deduction, I'm sorry, I'm going through it really quick. No New Jersey taxes if income under 10,000 for single, 20,000 under married joint. If you have more than two or more jobs and you pay too much unemployment disability, you can get it back. And military get an extra $6,000 tax exemption. And don't forget the homeowners anchor program, which they just didn't extend into January 31, 2023. Any quick questions on this one? I know I went through
Yes,
that.
I think someone needed clarification with over 62 or 62 and over for pension.
Yeah, 62 and over. If you are 62 and over, you can get an additional exclusion on your pension. If you have, and you can do that, 62 and over in New Jersey.
And that was the last question.
Okay. Real quick then, PA has a reciprocal tax agreement with New Jersey. If you pay PA taxes, let me also mention, it's important that typically you pay state taxes where you live, not where you work. So if you're working like in PA, but you live in New Jersey, you would ask PA to take out New Jersey taxes versus PA taxes. If not, then you end up having to do a New Jersey resident return and a PA non-resident return. You get the money back from PA, but you then have to pay New Jersey. So just keep that in mind if that's part of your situation. Retirement income in PA is not taxable. And that would be it. Anything on PA? Anyone has a question on PA?
No questions.
Okay. Some tax planning items real quick. Business meals are going to be rolled back to 50% for 23. Energy credit is going to be a much better credit. If you can hold off, you only have 3 weeks now, but if you can hold off doing some energy work next year, you get $1,200 a year per house, not just a lump sum of $500 total for the house. You can do $1,200 each year. And you can also get if you do an energy credit, you can get $150 back if you have someone do an energy credit. Solar is going to be 30% next year. Some people, you might, if you're in a situation, you can pay your 2023 tuition now to get the part of the opportunity credit. The EV, electric vehicle, as I mentioned. See if you can amend, and also cryptocurrency will be reported by the brokers beginning in 23. So any quick questions on any of those items?
No questions.
Okay. Then the final comments, make sure, I would recommend that you set up an IRS account. I would also recommend that you go to the IRS site and see all you need to know for 2022, which is a lot more than what I shared. do some tax planning either with yourself, whoever does your taxes. If you're using Turbo or one of the off shells, still spend some time doing some planning. Don't just do the return and call it a day. A big thing that I say to my clients is know why you owe or why you get a refund. The more you know, the better. Also know your tax preparer. Not every tax preparer is legitimate. And if you find yourself working with an illegitimate tax preparer, the person that's going to be at fault if anything happens is going to be you. So you want to make sure the person signs the return, make sure they have a PTIN, make sure they go through a appropriate number of classes. They don't have to do 35 like me, but they should at least do enough to make sure they stay up to date on new regulations. Congress is still in place. Some of these things might come back. Charitable donations for non-itemizers, that might come back. The mortgage insurance premium, Congress is still in session. Respond if you get a letter from the IRS, particularly CP 2000, which I think you're going to get a lot more people going to get that because the IRS just hired or in the process of hiring 8,000 new agents. The information is accurate as of 12/7/22, but Congress can make a change. One last thing I would say about audits, please don't think the IRS is stupid. When I talk with clients, if you own a mansion and you're reflecting only $2,000, $3,000 or $10,000 in income, you're setting yourself up for a lifestyle audit. The first thing the IRS is going to say is, how can you live over here making this? So just keep that in mind as you're working with your tax person and also doing your tax return.
And we have one more question.
Yes.
If you already lease solar panels, are there tax credits?
Not now. You have to go back and when you put them in and see if you can, if you go back 3 years and that credit's still out there, which it is, you might be able to amend your return 3 years ago or 2 years ago, whatever. But once they're up, then like I said, unless you put them up in 22, then obviously you can take the credit. But if you put them up before that, then you can see if you can amend your returns. You can go back 3 years to amend. Any other questions on that? Any of that? Okay.
No question, just kudos, outstanding info.
Thank you very much. These are just some things to keep in mind. If you need me, you can reach out, either email or phone. These are some other IRS websites and also New Jersey Treasury and PA. I really enjoy talking with you guys. You can see I really like this stuff. It is a lot, but I think, again, my clients, those who perhaps on the Zoom or you run across will tell you that I do try to spend as much time as possible with my clients to explain whatever they have. And if I can't get an answer, I'll go do the research for them. But it is what I do, it's what I enjoy. And by all means, please feel free to reach out if you think I can assist. And thanks again for listening to me tonight. Thanks again to the Deltas for having this program.
Thank you, Dr. Keel. Thank you. If you could stop sharing your screen so we can share some more information. So again, thank you, Dr. Keel, for all of this useful information for presenting, that you presented to us this evening. Participants, here is your time to let us know how you viewed this session and what else you may want the chapter to present. So in the chat, you will find a link. Sora Hazel.
That information was just so very informative, and I definitely thank you again. I know that you mentioned working with a legitimate tax preparer, and I think that that is so important. Also, we may need to make your series a two-part series because this was so much information. We probably could have, broken it into 2 parts. So we'll keep that in mind.
Okay, great.
Just a couple of reminders for everyone. We're gonna, take a break and have everyone enjoy the holidays, but we will be back next month to do the Get Your House in Order Wills and Estate series. So look out to register for that. That will be on January 18th, and we're excited. We know that session will be just as robust with a lot of great information. You will also note that our session last week on building generational wealth can be found on our Facebook page or on our YouTube page. So please go and check that out as well. There was just so much good information that was presented by Sarah Bullock. And then tonight's session will also be on our Facebook page and posted on YouTube as well. So please go back and check that out as well. Moving forward, the next couple of months, you'll see here, the slide shows that in March, we'll also be doing a session on funeral planning and life insurance, and then in May on home ownership. So please just, stay tuned, look out, register as you see those sessions pop up, and we'd love to continue to share all these great topics with you. Thank you.
Good evening. My name is Georgette Bowman. I'm president of Trenton Alumni Chapter of Delta Sigma Theta Sorority Incorporated. On behalf of the members of Trenton Alumni Chapter, I would like to thank Dr. Keel for presenting Taxes and You, Preparing for 2022 and Beyond. Very informative presentation with lots of information. I'd like to thank our Economic Development Committee, chaired by Sora Nicole Carmichael and co-chaired by Sora Janelle Hazel and their committee. Wonderful job. And I would like to thank all of our participants this evening. We appreciate you for taking time out of your schedule to join us as we get our house in order. So you see, we have a lot of information, we have a lot of things to get our house in order for, and with a lot of information that was shared with us. So we hope and we wish you a happy holiday season, and take the time to enjoy your family and friends and come back and join us in January. I'd like to wish you all a good evening, and remember to do the evaluation. Have a good night, everyone. Thank you.